Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful, sunny, somewhat wintry, but absolutely glorious Pacific Northwest. We are live on Facebook. I hope everyone's doing well. Hope you guys are staying safe. Hope you're staying healthy. Hope you're staying sane. Very important to stay sane in an insane world. And it's so nice to see you guys. I missed you last week. I was out of town. I was in Florida visiting family, and I brought the sunshine back with me. What can I say? You're welcome. It was really nice to see family, and it was really nice to get out of the ice box and the rain. And I know the winter here in the Pacific Northwest is just getting started, and we have a long, long way to go before we see real sunshine and real warmth again, even though it's really pretty outside. You could see behind me there, that's a lot of sun, and I'm here for it. In any event, Florida was interesting. Beautiful place and great weather. And I paid $2.89 for a gallon of regular unleaded gas over there. I wish I could have brought back truckloads of it at that price. When was the last time you guys in the Pacific Northwest paid something that started with a 2 for a gallon of gas? It's been a long, long time. And not to take this in a political direction, we're here to talk about the economy. We're here to talk about interest rates. We're here to talk about real estate sales. But the economy is a political thing. And my wife asked me, well, why do we pay so much more for gas in Washington State than we do in Florida on the other side of the country? Doesn't it all come from the same place? The short answer is yes, sort of. The more detailed answer is that there are different formulations of fuel per different state regulations. I'm not a scientist. I don't pretend to be scientific, and I don't know exactly what goes into the formulation of gasoline in one state versus the other. I'm sure it has a lot to do with environmental policy, of course. I'm sure it has to do with other regulatory policies as well. I'm not the expert on that, but I do know that the gas that you buy in the state of Washington, for example, is not exactly the same formula as what you would buy in Texas or Florida or Iowa or, you name it. And that's kind of weird. But the other thing is, of course, that there's a lot of taxes, and taxes are collected differently from state to state. Every state has a different policy for the way they handle their energy, and they handle gas, and so on and so forth. And I know that Washington, as well as California, and to a degree Oregon as well, all of us on the West Coast here, we are spending a lot more on gas, and a lot of that comes from taxes. So what can I tell you? There's a reason I'm bringing this up, and that is because energy prices go into the rate of inflation in general. And the lower the energy prices, the lower the rate of inflation. So I teased on my announcement today that we'll be having a 30-Minute Thursday. I mentioned that the rate of inflation is coming down, and that mortgage interest rates are coming down with that. And that is all true. And I want to jump in and share with you guys what that all looks like as best I can, because these are really broad and complex topics, and we only have 30 minutes, which sounds like a lot, but I blather on, and before you know it, it's over like that. So on let's see, Tuesday, I believe it was 2 days ago, the Consumer Price Index for the month of October came out. The Consumer Price Index is a measure of inflation, not the favorite measure for the Federal Reserve System. Those folks like to use the personal consumption expenditures. Frankly, it's a lot of the same stuff, but they're just weighted differently, meaning that in the CPI, the Consumer Price Index, the cost of shelter is almost 44% of the total 100% of costs that they look at. 44% of that is the cost of shelter. That's a lot, right? That's pretty significant. Whereas in the personal consumption expenditures, it's, I think, don't quote me, I think it's like 30% or 28%. So a different weight has different impact on these numbers. And so we have to take that with a grain of salt. But nonetheless, the Consumer Price Index for the month of October came out with a significantly lower rate of inflation than we have seen previously. I think we're somewhere, again, I didn't memorize these numbers, so take it with a grain of salt here, but we're at like 3.1% or 3.2% or 3% year over year inflation, which is great. That's fantastic. Keep in mind, the Federal Reserve Board wants it to be at 2% year over year. So we still have a long way to go in order to get to that rate. But we are definitely going in the right direction, and that is significant. And what that means really is not that prices are coming down. That's a mistaken conception here. Prices aren't coming down. I mean, if you go to Florida and you're from the Pacific Northwest, then yes, the price you're going to pay for gas, as an example, is going to be significantly lower. But that doesn't mean the prices are coming down. What it means is the rate at which they're going up is slowing down. That's really the deal. Remember, inflation is still there, and the Fed and the government and the powers that be are trying to manage the rate of inflation, but they want to see year over year 2% increase in costs across the board. And so what cost $1 this year, in theory, should cost $1.02 next year, et cetera, et cetera. They'd like to see that across the board. So that doesn't necessarily mean that prices are coming down. That doesn't necessarily mean that we're going to see a ton of relief at the grocery store or at the gas pump or in rents or in things like that. That's different. That's disinflation or deflation. That's a completely different sort of phenomena within the range of economics. All this means is that the rate at which prices are going up is slowing down, not stopping or coming down. But the market's like that. That was really, really good news on Tuesday, and things within the bond market and the stock market, for that matter, are moving in the right direction, which is very, very exciting. What is the right direction? Well, interest rates are starting to come down. That is fantastic. Mortgage interest rates especially are starting to come down, and that is a relief. Now, we're still significantly higher than we were 2 years ago or 3 years ago. The average right now for the 30-year fixed, I priced out a loan for one of my clients earlier today. We're somewhere around 7.375, 7.49 on the 30-year fixed. That's not great by comparison to, what we were doing in 2021 when it was like 3%, but it's a lot better than 8%, which is where we were about a month ago or 6 weeks ago. So things are definitely moving in a favorable direction here, and that is significant. I mean, in any other time, if you had a decrease in mortgage interest rates by 0.5%, people would be jumping for joy. We'd be doing a lot of refis, things of that nature. That hasn't happened yet, right? I mean, we're still so far elevated over where a lot of people's mortgages are right now that we're not doing a lot of refis. That's the unfortunate thing. But we are starting to see things moving in a direction that is helping people come off the sidelines and decide that they actually want to get engaged in buying a home, which is really exciting. And in time, we're going to see people actually start to get into a situation to refinance mortgages that we had done previously. I apologize, guys, in advance here. It's still a live broadcast. I'm getting a bunch of noise from my teams because there's something going on here that I'm not participating in, but my Teams was open, and I don't know if you guys were hearing the dings, dings, dings of people communicating amongst themselves, but I'm trying to stop that, and yet, unfortunately, the messages keep coming. So hopefully it's not intruding on you guys. Certainly I can plow through this, and I'll continue to just keep working. But coming back to what I was saying, the rate of inflation is coming down, and that is really important. Mortgage interest rates are also coming down, and that's also important. About 2 weeks ago, gosh, I apologize. This is super annoying, at least to me. So I'm going to try to shut this off once again. I'm going to try to exit out of this thing, and hopefully people will stop pinging and dinging and whatnot. But that's just really annoying. In any event, a couple of weeks ago, earlier in the month of November, we had a jobs report that came out that was also really significant insofar as it showed that unemployment is going up. And that's not a happy time, right? I'm not happy that people are losing their jobs. I'm not happy that the Bureau of Labor Statistics is doing all sorts of restating of previous employment numbers, saying that, you know, what we were looking at previously that were super strong jobs numbers was actually people getting second jobs because they couldn't make ends meet with their primary employment. That's not happy. That's not great. It's not great news that the bulk of the new full-time jobs that the Bureau of Labor Statistics, the BLS, is reporting is coming from the government sector. Government sector jobs don't create anything in the economy. They are, it's fine, you know, whatever I have friends that work for the government in a variety of different roles, and so be it. But they're not really creating anything. Government doesn't build anything. Government doesn't create product. Government doesn't provide services. Government is a factor of the economy, and it takes from us to do whatever it does, but they don't create a net positive. They are what they are. So this was, gosh, I want to say like the 3rd of November, early in the month. What we found out with the Bureau of Labor Statistics is that they are restating all their numbers. They're showing that a lot of these jobs are not real jobs insofar as new growth. It's people taking second jobs, and it's also people working for the government. And that just does not create a very strong economic engine. The good news, if we look at it from the right perspective, is that this is what the Federal Reserve Board has been trying to accomplish all along. They've been very direct in saying that we want to see jobs come down. We want to see unemployment go up. We want to see people not working, because when people are not working, when employment is tough, when people are dealing, you know, with second jobs just to make ends meet and doing things of that nature, what that does for the economy is it slows the rate of expenditures, what we call the burn rate. How quickly are you burning through the cash that you've got, either from your salary, from your savings, or on credit? The more you burn through your stuff, your cash, the less you have to spend in the future on other things. And so when people have less income, when people's jobs are not as secure, when they're not making as much money, when they're not getting signing bonuses, et cetera, it creates less money for them to spend on things like clothing, like rent, like new cars, like used cars, like food, like gas, like travel, like all the things that they are looking at, the bureaucratic statisticians are looking at when we talk about the consumer price index and the personal consumption expenditures. So the more we see unemployment go up, the better it is, at least according to the Fed, as far as how inflation is coming down. And so it's kind of a weird push-pull sort of thing where they want to see more pain. They don't want to see the economy broken, but they want to see more pain in the economy, because when people are fearful for their jobs, when they're not really making the same kind of money as they were a couple of years ago, they're certainly not spending as much money as they would be. Now, this is weird because our economy is massive. And for those of us who live in certain areas like the Pacific Northwest, you live in the Seattle area, Bellevue, King County area, I go to restaurants and I see that they're packed. I go to the shopping mall and I see that there's plenty of people out there buying and spending and doing whatever. But I know that that's not the nature of the entire country. And so I know that there are people out there that are having a hard time making things happen for themselves. And that's not good, but it's what the Fed has stated that they want to achieve. It's what they said is going to solve this problem for us. And they're going to continue to push on things until they see this number come down to 2%. That's kind of like their big number. That's their big issue. Now, there's a lot of things that could happen here. We're not sure how it's going to play out. The unemployment rate is one thing, but if people go unemployed for too long, guess what? The government's got to step in and bail those people out, right? All of a sudden they start making, or they start they stop making their car payments or their mortgage payments, or other things happen, and there's an effect, a cause and effect in the economy. Everything's connected in some way or another. And so the idea that we're going to just suddenly create unemployment and it's going to bring the cost of things down without creating some sort of unintended consequence down the road, that's I hope it works out, but I don't know that it will work out. It remains to be seen. What the Fed is really afraid of is letting off the gas too soon and letting inflation burst back up onto the scene, which is what happened in the 1970s and early 1980s, where they thought that inflation was contained, they changed their policies, and then it erupted. And that double top is what that's called. So you have a peak, it comes down a little bit, and then it peaks back up again. That's really what they're trying to avoid. So the Fed meets again, in the middle of December, like within the next 30 days. They're going to meet right before the holiday season. And I would say that they're not intending to raise interest rates again. I think the numbers that they've got right now, the markets have priced in the notion that they're not going to do another rate hike in this calendar year 2023. Their last meeting is in December. And so that's probably a pretty safe bet. There's also talk that they're going to pivot, the fabulous pivot of the Fed, which is we're going to go from raising interest rates to cutting interest rates and re-stimulating the economy. Excuse me. There's a lot of thinking that might start as soon as second quarter of 2024, maybe like the summertime. So like May, June. Hard to predict exactly what's going to happen. There's a lot of things that are going to happen between now and then, but that's kind of on the table as well. And that would be a very interesting proposition to see that they start cutting again. I don't know what that would look like. We'll see. We'll definitely keep our eyes open on something like that. Keep in mind also, of course, that in 12 short months, we've got a huge presidential election cycle with also, Congress is up for a re-election, et cetera. So most of these policymakers don't want to be sitting at the helm going up for re-election and the economy being, in a disaster or unemployment being super high. So the Fed is supposed to be independent, but hard to say what that actually looks like as far as independence goes. I would dare say that they're definitely getting some push, some impact, some whatever lobbying, for lack of a better word, from the powers that be within the elected class as well. So it's a strange proposition, the political as well as the economic. But the good news is that things are starting to shape up. And when that happens, and I've been saying it month in, month out, and it's been a long slog. 2023 has been a very, very strange year. It's been a tough year for consumers. It's been a tough year for real estate brokers. It's been a tough year for mortgage lenders. We went from being in the fast lane of the Autobahn in 2021, where we were doing, banner years, and now we're in the slow lane behind the school bus, making stops at every corner here. It's just the nature of the cycles. But when this does change, we still have a ton of demand. We still have unprecedented levels of demand, and the affordability has been a challenge for a lot of buyers. They're still wanting to buy, though. That hasn't gone away. It's just been on hold. And so what happens when interest rates come down to 6%? God willing. I mean, that would be great. They come down another 1.5 to 6%. It doesn't even need to start with the 5. It would be a reduction of roughly 2%, maybe even more from the peak where we were about a month ago. What happens with all those buyers? I mean, do they think that like now's the time to get back into this market? Now's the time to really, lock this thing down because we've waited, we've been patient, and we've been rewarded. And now interest rates start with a 6. I think that we see bidding wars again. I think that we see a lot of pressure on prices going upward, especially in areas like the Pacific Northwest, where they don't build a ton of real estate in general. What's been keeping the industry afloat, for lack of a better word, these last few months has been new construction. New construction is roughly 15% of all homes sold in this country. It's only 15%. All those big builders, whether it's D.R. Horton or Centex or Toll Brothers or you name it, it's only roughly 15% nationwide. The rest comes from resale, basically older homes that like mine, where someone lives and they decide, hey, I'm selling my home. Well, that has frozen basically, because why would I sell my home where I've got a really good low interest rate? I wouldn't sell it unless I absolutely had to. And so it's been kind of an impasse. So there's not a lot of inventory, and there's still, I don't know. I mean, if we see interest rates at 6%, would that be enough to get someone who's sitting on a 3% mortgage to sell their home and buy something else? If they needed to, like I need to upsize or I need to downsize, or I want to move to a different part of the country or a different part of the world for that matter. I'm not sure. I don't know. I honestly, I don't know. I'm just thinking out loud. What's it going to take to get a lot of home owners to sell their property? Or would I just turn this thing into a rental and sit on that super low 3% interest rate until somebody else pays off my mortgage for me? Hard to say. Hard to say. But what I will say is that as these rates come down more and more, what ends up happening is that more buyers will come into this market. It's inevitable, because there's a lot of people that still want to buy a home, and I think that they've seen what could happen in this economy if they snooze and lose, and now they end up being a renter for more years to come. What if this is just that dip in the mortgage interest rates, and we hit 6%, but then we go back up? So I think we're going to see a lot of people take this as an opportunity to jump into the market. We're not at 6% yet, guys, so don't kill the messenger on this one. But we are moving in that direction. We're in the mid 7% range, and knock on wood, continuing to move lower. So what happens when we do get into the 6% range? I think all that pent up demand comes rushing back into the market, and we see prices go back up. And that is especially true, like I said, in parts of the Pacific Northwest and other markets where they just simply don't have a lot of inventory. So if you are thinking about buying a home, if you're looking, if you've been looking, if you've been waiting, if you've been diligently, patiently waiting, the time is coming up, guys. The time is coming up. We're in the winter. I mean, I know it looks really sunny back here, and I'm wearing a short sleeve shirt, and that's fantastic. But winter is typically a slower time of year for people to buy homes. Starting in the springtime, starting in March or April, boy, it's going to get heated again, because people are going to want to move in the summer. And if we get to that point where we see the Fed pivot, I don't know that they will. I'm just saying if they start to pivot sometime in May, June, second quarter, late second quarter of next year, and interest rates come down even further, then we're going to see a huge land rush here, a huge sort of fight to claim a home, to get into a property. And so I would suggest that if you are looking to buy real estate, if you even remotely want to make that change, now is the time, guys. I mean, things are starting to move in your favor, but you can still do an inspection on real estate. You could still negotiate on price. You could still ask the seller to pay for your closing costs or buy down an interest rate. You do a 2-1 buy down with the interest rate at 7.5 right now. That means that for your first year, your payment's going to start at 5.5% for the first year of home ownership. 5.5% is a bargain, right? So, and you can get that done today. I don't know what happens next spring or next summer. It may be there, it may not be there, but things are mercifully moving in the right direction, and that is a relief. And I think that as they continue, and as we see interest rates come down, and I hope it happens sooner rather than later. And remember, that election year is a wild card. Those politicians are all calling up their Fed people. Hey guys, we got to make sure this economy is looking good for my reelection coming up in November. I don't know. I think maybe we see some kind of softer landing, some kind of reduced interest rate environment, and all of a sudden a lot of people perk back up and a lot of buyers come back into this market. So I would suggest that if you are one of those people that wants to buy a house, let's talk sooner rather than later. Call your real estate partner. Real estate partners, call me. If you've got clients sitting on the fence and you want to talk to them about that, please reach me. Let me help you talk with them and explain to them where we are in this economy, explain where we are in the cycle, and possibly answer their questions and help them figure out what to do next. This might be kind of the best time before things get heated up all over again. So I would love to work with you guys. I'd love to help you with that. With that said, we're right about 30 minutes. Like I said, time flies when I start talking. It's amazing. I want to take a moment and wish everybody a happy Thanksgiving. I should have started at the beginning with that. I can't believe it snuck up on us so quickly this year. Like, it just happened. Now, it's kind of early in the month, right? I think we've got 5 Thursdays, yeah, in the month of November. And I think that's kind of what snuck up on us here, because it's going to happen on the 23rd. Usually it happens like the 26th or the 28th. Seems a lot later into the month, but Thanksgiving is right around the corner next week. I can't believe it. It's my favorite of all holidays. I love Thanksgiving. We have so much to be thankful for, so much to be grateful for. And I'm grateful for all of you folks who have been watching my 30-Minute Thursdays for years now, years. I started in April of 2020. We are going to be, we're 3.5 years into this, which is amazing. And I will continue to do it as long as I got one person watching, one person other than my mom, who I love, who I adore, who does watch. And I just give a hard time because, of course, mom's going to watch. But honestly, I thank you all for watching. I thank you all for participating. I would love to hear from you. I would love to answer your questions. I would love to help your clients or your colleagues, whatever it is. Please, I spend a lot of time researching and getting my arms around the economy, the inflation, monetary policy. I'd love to speak with you guys and answer those questions to help people make great decisions. So with that said, I look forward to hearing from you, but I will not see you next week. I will be overeating as always. I will see you, my goodness, in the early part of December. I can't believe, no, I take that back. I will see you on the 30th of November, that 5th Thursday of this month. But until then, I hope you have a fantastic holiday. I hope you stay safe. I hope you stay healthy. I hope you stay sane. And I hope you stay in touch. I'll see you soon. Y'all take care.